Tuesday afternoon again. We're here for our weekly Q&A, and this week we've had a lot of questions around a fairly topical event that's occurred in New South Wales and Australia, where the state government is looking to try and further kickstart the economy, and one of the areas that's always been in discussion and people have had some pretty divided views about how stamp duty is holding back perhaps not just the state economy, but people being able to move as they should freely from home to home to pursue employment or education or other potential things that would be beneficial both for them and for the community at large. So New South Wales Treasury has now put out a discussion paper for public feedback in relation to this, and clearly it's still in its early stages in relation to where this is going to potentially head. But I've already had a lot of questions from people saying, shall I wait and not buy something now because I'm potentially going to save having to pay stamp duty? So the answer, of course, is that depends, as with many things. But let's look at things realistically. At this point in time, there's still a lot of public debate to be had. There are people that are going to make submissions in relation to whether the stamp duty should be abolished, how this should be, implemented. And we also need to look at what the discussion paper has come out with so far in relation to both people who are buying a property to live in, so as owner-occupiers, and also people who are investing in property, so buying something to further their financial futures and create a bit of an asset portfolio for themselves, as these properties are currently treated differently. So I've put up here on the board behind me some things that we need to think about. And effectively, what Treasury is saying is that they're going to try and bring in this property tax, as they call it, which will be a tax on unimproved land value to replace both stamp duty and land tax. And currently, the government is saying that over the next 4 years, by removing stamp duty, it will cost them around $11 billion. Stamp duty, as we know, is one of the largest sources of income for most officers of state revenue. So it's something that there's a lot of thought, particularly from the government's viewpoint. And as I say to people when they ask me about these questions, I don't think that what we're going to get is simply going to be a gift from Santa Claus saying, look, you're not going to pay stamp duty and off you go. What's actually being proposed at the moment is quite different. It's somewhat unique. I think it's interesting, but there are some really important things to bear in mind, because once you give up your right, I suppose, to pay stamp duty and you move to this new property tax regime, that property can then never go back to a stamp dutiable situation, because ultimately, obviously, it's the government's aim to try and create a situation where we more and more properties into this new tax realm. And it's sometimes important to, I think, remember that the government can often alter perhaps the rates of tax down the track. There can be other changes made. So it's really, I think, crucial to think about why you're buying something. If you're buying a property to live in, that means potentially you're going to live there long term. Is it going to be a forever house? And if it is, I think you're far better off paying stamp duty, to be honest. Also, if you're an investor, you've got to look at the pros and cons of all of this situation, because currently in New South Wales, stamp duty is about roughly averages 4%, say, of an acquisition cost. So it's obviously a fairly sizable chunk. Average property is $1 million around Sydney, so that's $40,000. However, the government's not going to let that go for all time. So this new property tax is going to work a little bit differently. So if you look here, owner-occupied residential property, currently, yes, you need to pay stamp duty, but no, there's no land tax payable as it is your main residence. The proposed property tax will cut in at, it will cost $500, Treasury is saying, plus 0.3% per annum. Doesn't sound like too much, But again, work out how long you're going to keep that property for, and don't forget that is a charge on unimproved land value, a bit like council rates. So if you look at it as an investor, investment property, currently you need to pay stamp duty and you need to pay land tax. Land tax can be a pretty significant impost because in New South Wales, whilst there is a reasonably generous tax-free threshold of $734,000, above that we have to pay 1.6% land tax, and when the land value goes above $4,488,000, that bumps up to 2%. So a very significant amount. And that's going to be replaced under this new regime potentially by a charge of $1,500 per annum plus 1% of the unimproved land value. Again, you've got to look at that and say, if I'm going to keep an investment property for 10 or 15 or 20 years, how am I better off? Am I potentially better off paying GST and then paying land tax if I happen to have to by going above the threshold, or am I better off under this new proposed scenario? That's something we have to look at as these things, I guess, become firmed up to some extent. Farmland, currently, yes, you have to pay stamp duty on that, but no land tax. And again, farmers are going to be given a bit of a bonus. They have to pay 0.3% going forward. Commercial property, currently have to pay stamp duty and land tax. And as we can see, going forward, the proposal is that on commercial property, we will need to pay 2.6% per annum on the unimproved land value. So you can see that it's fairly technical. There's a lot involved, and I don't think you need to try and charge in to do anything rash, both now and in the immediate future, in terms of, I guess, influencing your decision to purchase or sell and then purchase, to try and make use of these measures. Because one of the other things that's come out in the Treasury discussion paper is that they will probably bring in a retroactive situation where if someone has sold or bought their property in the last few months, there may be a refund of the GST applicable if they then want to go onto this new property tax. So if we look at that in context, it's important to see that this is still in the planning phase. It's a massive amount of money, as I said, $11 billion over the next 4 years for the state's coffers. So I think the government and Treasury are going to be fairly astute in terms of how they're going to cost this out, both for now and the long term. They're saying that longer term they expect this to be cost neutral. I wonder about that. We'll see what happens. And other studies have shown that each dollar of stamp duty that's spent at the moment is basically a dollar that's taken out of the state economy. So lots of interesting things around that we need to bear in mind. Treasury also said in their paper that they think longer term that may have the impact of lowering home values. Again, that's something that I think is potentially somewhat problematic, because I don't think that home values are driven to a massive extent by this situation. It's more by other sort of generic factors that influence property values, scarcity, location, closeness to infrastructure, education, transport, all those things, lifestyle especially now. So I don't think the taxing impact is going to be a significant one in the long-term future, but we'll wait and see what happens. So, to the person that asked me about that, I hope that's a reasonable answer. It may be a little long-winded, but there is quite a bit to this. And then to the other people who asked me who are buying or thinking of buying things in both Victoria and Queensland, as I said, this is for New South Wales only at this point. There may be something happening there, but that may be years off or it may not happen. So I think at this point in time, I wouldn't be too concerned about that and just keep doing exactly what it is that you're doing for now. So that covers it off. We'll keep an eye on the situation as we do with everything. You can follow Wise Guru on Facebook. and we'll post things in relation to anything that we think is important for both Australian expats or Australians at home in relation to legislative changes, especially as they pertain to property and also investment. Another question, well, I've had a couple of questions actually in the last week that are sort of a little bit similar, and I'll go through those in some more detail. So one person said to me, look, I've got an old property that I've got back in Sydney, and interest rates have come down even further. I don't owe a lot of money on that, and I'm now currently paying quite a lot of tax because I'm paying non-resident tax rates and I don't really have many deductions. So what can I do about it? And I said, well, look, that depends on a lot of things. Let's ask a few questions first. How much is the property worth? Pardon me. And they said it's worth $1 million. How much do you owe on it? It was $300,000. So, pardon me, a pretty low level of gearing at 30%. Rent was $520 a week, I think it was. So it's around $26,000 a year. And there were no depreciation expenses because the property was well over 70 years old. And interest rates had come down. These people were paying principal and interest, and they were now looking to fix that at like just over 2.5%. So you can do a number of things, I suppose, and it depends a lot on what you're trying to achieve. If you're just trying to shield yourself from tax, you know, you may be eligible even as an expat to make a personal superannuation contribution to a public offer fund and perhaps offset some of that tax that way. However, you'll still be taxed within the fund. Or you might be able to use this more as, I suppose, a springboard to build on that property and create a bit of an investment portfolio whilst you're offshore. And to this person, that seemed more interesting. So I'll give you an idea of how you could potentially turn the situation of having the surplus income and paying a penal rate of tax on it into, I guess, the opposite situation where it's actually a huge bonus in terms of what you can achieve. Let me just... Let's have a look. So, if we have a look at the situation where we had this old house and it's worth $1 million and there's $300,000 outstanding on it at, say, 2.5% principal and interest, but let's just look at the interest component of this so we can see we don't have much debt against this property. And the issue is we've got about $20,000 worth of surplus income at the moment that's being taxed at 32.5 cents on the dollar. So what can we do? Okay, well, here's a concept. If you wanted to buy, say, an investment property that's also $1 million, how can you do that without actually physically utilising any of your own cash as such? And one way, obviously, to do that is to create another facility here against this old home, use some of this lazy equity, and make that perform your treasury function. So our clients can get up to 85% loan-to-value ratios with no mortgage insurance, which means $150,000 borrowed here can go in and act as deposit, plus costs, and the $850,000 can get secured against this. What's the outcome? Well, if this is a new property, we also have Division 40 and Division 43 non-cash depreciation tax deductions. So currently this $20,000 of surplus income is sitting here being taxed at 32.5%. But we've now got to add to this, and the income on this property is greater, so it's $45,000. All up, we now have $65,000 worth of income, so we're worse off as it were at this point in time until we take our expenses into account. And if we add this together and say even at 3%, that's $30,000 of interest, both the interest for this and the interest for our deposit over here. That leaves us with $35,000. But interestingly enough, on a property like this, you're going to get at least $35,000 in depreciation allowance and other expenses. Most of these are non-cash expenses. So you could end up with a situation where you no longer have surplus income, as it were, and you don't have to pay any tax. It depends a lot on both properties, and this is more generalised, so it's really just from a strategic and a conceptual situation. We have to delve into this and work through all the numbers, if you like, you know, in terms of line items, the cash items and the non-cash items. But as you can see, if things align, you can effectively purchase another $1 million asset and actually have it funded by your surplus income at the moment and whatever the tax office is contributing towards that. Quite often you'll end up with a positive cash flow because you've got excess tax credits that you're not having to spend cash for. So it's a really good situation at the end of the day if that's what you're looking for. There are permutations on this. You don't have to gear this by 100%. Some people say, look, I still want to have a little bit of the income, but you've got to look at that. If you need it, fine. If you don't, you probably don't want to pay a third in tax at this point in time, and you'd rather add up perhaps some more tax credits that we as Australian expats can enjoy when you repatriate back home to Australia. You can offset that against your personal exertion income. If you're then going into employment, you can offset it against other income, and really it is an asset. So you're saving for your future there by simply turning around a very inefficient situation that you currently have and moving into a situation that can actually progress forwards, because if you're away for, say, I don't know, 4, 6, 8, 10 years, you could do this again. And all of a sudden, all of this lazy equity that's been unlocked is really going to work for you along the way without costing you money, so that your lifestyle doesn't actually suffer. That will work for some people, something else will work for someone else, and that was just something that I said to this person who asked me that particular question. And it was similar to someone else who asked me just the other day in relation to, look, they're not sure what to do. Should I buy an old property or should I buy a new property? And this was for investment purposes. And they said, I'm thinking of actually buying an old property and a new property. And I said, well, not a bad idea. If that's what you want to do to diversify where you're going to be at, sure. No one has a crystal ball in terms of which one is going to do better for you in the long term. I certainly don't. But if you look at that, it's similar to this in some respects. You can have an old property with none of these deductions and a new property with all of these deductions, and if you meld them together, you're going to come up with a far better outcome than if you potentially just had one or the other. So, you know, again, it really depends on what the situation is, when you're going to move back potentially, are you wanting to move into something to live in it or not? These are all questions we have to ask ourselves all the time. But, you know, it's just something that I wanted to show everyone today, because we do this every Tuesday. But tomorrow we're having another event which really goes and has a far deeper look into what the current low interest rate environment could potentially do to assist us all as Australian expats. I hope this has been helpful and look forward to seeing you all again next Tuesday.